Hey, Happy New Year guys! This is Terry welcoming you to 2021's first episode of Invest Roundup. The stock market ended in 2020 on a record high despite the pandemic still going strong, with vaccination activities just starting. This is partially due to positive economic outlook for year 2021, now that there seems to be light at the end of the tunnel. Facebook has big plans for the year, so big that Godzilla could climb on top of it. The EV industry is gaining more and more traction as innovations start to roll around in attempts to make the next car better than the last. And as a result, more companies are involved and more stocks are jumping in the market. Others, or what I call the industry survivors, are coming out of their hiding places from the storm stronger, more capable and ready to fight again. It looks like an exciting start to the year, so let's get started. Disclaimer: whatever stock or news we talk about is not a recommendation to buy or to sell. These are all just news we deem important, things we think you need to know about if you're invested in the stock market or if you intend to invest. First news item, let's look at the EV industry's journey of a million miles. We've all heard of that hit song, 500 miles? Or was it 1000 miles? Anyway, a Chinese company is taking it to another level by introducing a 1 million mile battery. Yeah, you heard that right. With electric cars on the uptrend lately, battery makers are now also getting a splash of popularity. One of it is Contemporary Amperex Technology Co. Limited, or CATL for short, the world's largest maker for batteries. The battery producer for Tesla and Volkswagen recently developed a power pack that lasts 16 years or more than a million miles. That's like circling the planet 50 times. This means the battery pack can be reused in a second vehicle and lower the expenses of owning an EV. Overall, cheaper than our current cars that are running on petrol. One of the major concerns that's been holding car owners back from adopting electric vehicles are their batteries losing strength and having to be replaced after a few years. So, with this announcement, looks like there will now be more reasons to get an EV. According to CATL's founder, there's pent-up demand that was created during the pandemic which will be unleashed starting this year. Experts forecast that China will make up 8.1% of all sales, the largest share of global EV sales, followed by Europe with 5% sales. CATL's shares on the Shenzhen Stock Exchange have increased sixfold since its IPO and its market value is currently at about 47 billion. They've also struck a 2-year contract last February to supply batteries to Tesla, who, by the way, recently came out with an affordable Chinese-made model, Model Y, and has been approved for sale. But for now, the 1 million mile batteries, which are produced in a factory near Shanghai, are set to go in Tesla's Model 3 sedans. CATL also announced that they are adding a production facility in Germany to make batteries for major companies like BMW, Volkswagen and Porsche. At the moment, it looks like CATL is fundamentally solid but might be overblown in terms of price because the share price is now way above its intrinsic value. It's gonna be a long runway for the EV industry, you guys, and in case you haven't heard, Chinese EV maker XPeng is upping their game even further and recently announced a collaboration with lidar company Livox, presumably to develop even better self-driving cars. Second news item, guess who's Facebook's latest moneymaker? In a stealthy and under-the-radar deal, Facebook recently bought a customer service software startup most people had never heard of at more than $1 billion called Customer Inc. Now, it is not news that Facebook has been under scrutiny for the longest time for its impact on US politics and the economy. Regulators are constantly at their tail and politicians condemn almost every move the company makes. In fact, if you recall our Invest Roundup last week, state and federal officials are now filing antitrust lawsuits against Facebook alongside Google, allegedly for monopolizing the industry and staving off competition by acquiring smaller companies. This is probably why the deal drew very little notice. Even though this deal comes as no surprise to most people, you might be thinking, so what? Facebook is always acquiring new companies, right? Little do they know that Facebook, the owner of WhatsApp with more than 2 billion monthly users worldwide, now has a plan. You see, despite its gigantic reach, WhatsApp currently makes little to no money. But just recently, Facebook founder Mark Zuckerberg announced that the next big plan will involve WhatsApp. According to the founder, he sees private messaging as the foundation for his next big business, and WhatsApp has the potential to transform into a profit center by enticing retailers to sell goods and services in it. Even though Facebook has been known for its advertising platform and makes most of its revenue from it, it's only a matter of time before people start leaving the platform. And Facebook knows this, hence the switch to WhatsApp to diversify its business. Eventually, Facebook believes it can control the entire exchange between a brand and its customer, from ad to product sales, and finally, using WhatsApp as the cash register. Early last year, Facebook already invested $5.7 billion in Jio Platforms, an Indian internet giant to partner with on commerce, and early last month, WhatsApp confirmed that it's adding a cart feature to the app. This is to attract more merchants to come on board and invite more WhatsApp users to shop during the holiday seasons. They've also previously unveiled QR codes, a dedicated shopping button, and the ability to share catalog links in the chats. For those who've been following WhatsApp from the beginning, you would know that this is a stark difference from when WhatsApp was first created with the mantra, no ads, no games, no gimmicks. Today, even luxury store personnel from brands including Miu Miu, Burberry and Valentino are turning to WhatsApp to correspond with their high net worth customers to alert them about the latest products and offerings. Despite the possible issues with the authorities, Facebook is now still considered a low-risk investment from a financial point of view. By the way, before we go on to the next news item, click on the subscribe button below now so you'll be informed next time we upload a new episode. That way, you won't miss any important market news. Third news item, why isn't the storm taking down Nordstrom? In case you didn't notice, the retail industry took a massive beating in year 2020. In fact, physical retail was already in decline even before the pandemic, and the year 2020 was the final slippery step that threw these brands right off the cliff. A lot of decade-old brands did not even make it after being in the industry for so long. But among the debris of what's left stands a strong and resilient department store that, against all odds, is still surviving gracefully: Nordstrom. According to experts, with the reduced competition and the company expanding their businesses online, it looks like Nordstrom will not only be a survivor, but possibly a long-term winner. It now has far fewer traditional stores than its competitors, hence lower expenses. It has permanently cut costs by $300 million or so during the pandemic, and in the recent years, they have been pouring money into the online business with a website and a user-friendly app, which means investors can expect a margin boost, especially relative to its competitors. The company has also been getting more efficient in allocating their costs as it closes more stores and literally shrinking the ones still open. The net sales per square foot have been climbing steadily in recent years, from less than $400 in 2012 to a whopping $509 in 2019. Shares have been up 110% in November since bottoming in September and soared 17% more in December after reporting good results of 34 cents a share. Its digital sales had surged by 37% year-on-year to $1.6 billion, or 54% of its total sales, even though sales at its full-price stores plunged by 7%. From a fundamental point of view, even though it is not looking all that good in terms of growth at the moment, experts are optimistic that sales will return to profitability in fiscal year 2022. And finally, let's look at the guys in the construction industry. Is Caterpillar finally ready to spread its butterfly wings? Now that businesses are slowly going back to normal, things are equally looking up for those in the construction business. This includes the maker of heavy-duty machinery, Caterpillar. Along with its peer, Deere, the share price for Caterpillar are up following a forecast of upcoming demands after the industry bottomed last year. In fact, according to experts, demand for construction equipment is already starting to improve and sales are expected to be up roughly 8% in 2021. Side by side, Deere currently has the upper hand on Caterpillar with a gain of 46% compared to Caterpillar's 20% gain in 2020. However, both numbers are better than the 13% and 5% respective returns of the S&P 500 and Dow Jones Industrial Average. And apparently, this is typical of cyclical stocks. Stocks like Caterpillar, Deere, and other cyclical stocks typically outperform the market when the economy is growing. So if all goes well with the vaccination, the economy rebounds, which means more construction activity and high expectations for the earnings for these machinery companies. Analysts are now expecting 2021 to be an early cycle year for these companies and when machinery stocks typically perform the best. Some skeptics are now questioning how much of the rally is left considering there's already been that much increase in 2020. But others argue that Caterpillar's true outperformance potential is still ahead. An article even calls it a top idea for 2021. At the moment, Caterpillar looks good on the dividend front but not so much on growth. So we'll see what happens in 2021. The COVID-19 pandemic has been a major headwind to Caterpillar's business because demand fell hard in all of its business segments. But thank goodness, business is now becoming more concrete. So, those are the 4 important investment news we had to share with you this week. Once again, we encourage you to get more information if you'd like to act on any of the companies we've shared about earlier. Comment below and tell us what you'd like to see on Invest Roundup and share this video with your friends, especially those who are invested in the stock market. Here's to a great new year and we'll see you next week.